Good morning, everyone, and welcome to today's session. I hope you're having a good time beginning of the weekend. So today we have chosen a topic, top five investing mistakes. What we are trying to do here is we are going to give you the top five, basic investing mistakes, and we are going to come up with a follow-on session with a more detailed and the next investing mistakes to avoid. So stay tuned with us for today's session and to the follow-on session that we are going to have. Okay, so without wasting much time, I'd like to first start this session with a question. So what is your priority on your payday? So we'll have a poll question now, and you can give me your answers. So this is going to be like a background or a foundation for our today's discussion. So these are the options and you can choose. I request all of you to please participate. So this is going to be an interactive session. Wonderful. We are seeing that most of the audiences are choosing save or invest, as the first priority on a payday. That's wonderful. So we are having a well-informed audience today, and we are happy about that. And we hope that our sessions are also helping you and add value to your decision making, to your knowledge, and about financial well-being. Yeah. Thank you so much. Thank you so much for that. So yeah, it's quite clear, right? So the first priority should be, to save, and then to, first comes the expenses actually, because fixed expenses, there's no other option. We have to spend for our fixed expenses. Then comes the priority of saving or investing. So most of the times what happens is saving and investing are spoken about in an interchangeable way, but it is not so. Sometimes what happens is saving is you just let some money accumulate in your bank account. And then the next step is where do you put that money so that it grows, for the future. So save, first step is to save, to see that you're not spending in an adverse way, and you're able to save for what is required for your goals, and then where you put that into what avenues or investment opportunities where it is helping you grow and achieve your dreams or goals. So that is the investing part. So that's very good to see that a lot of us are doing it properly. So now, there was a survey conducted some time back, and it was conducted for a people of around 3 lakh to 5 lakh people. And this was also the observation that a lot of people in India are becoming aware of, saving. And saving has been there in our life and blood, in our Indian tradition from a long time. But slowly, people are moving towards investing and putting, helping the money grow and helping the, making the money work for them rather than they working for the money, right? So we have seen that 67% voted that they invest first or save first, and 33% said that they spend first. We still see that there is 33% of the population who don't understand the power of saving or investing. Okay, so how is that linked, to our today's session? I'll gradually take you through that. Okay, so what happens in an average Indian working class family? So this is how, on an average, the income is split between, essential and non-essential expenses, savings, and EMIs, right? So you see that 35% of, in an average Indian household, 35% of the income gets saved. That means there is good savings potential and investing potential. That is why we see a good growth in savings and investment avenues. Wherever it is, people are trying to come up in life and do what is best for their families and children. And a lot of them we see that are talking about early retirement also from the last few years. So that's about it. Now, coming to that, how many of you follow a budget? How many of you have a budget? Do you have a budget? So let's have a poll question here, Sanjay. That's amazing. A lot of us, a lot of you follow a budget, and discipline is the first step, right? So discipline comes first and then follows everything else. So if you're disciplined, that means the half the job is done. Fantastic. So yes, there is almost 39% also saying that they don't follow a budget. Yes. So you should follow a budget, right? So let's see as we progress. Oh, sorry. Yeah. So you should follow a budget. There is always a thumb rule, in personal finance. It is called the 50-30-20 rule. So the first 50% goes away in your day-to-day needs. Okay. There's a I'm sure you know the difference between needs and wants. Needs are something which you cannot avoid, which is your basic necessities of life, and their foods, your bills, insurance, and healthcare, your EMIs, everything that comes and forms a 50% of your income. So these are the ratios which say that 50% goes for your needs, your basic necessities. 30% goes for your lifestyle expenses like your hobbies, your eating out, shopping, and at least 20% should be saved. The ratios that are given here are like maximum ratios. For example, if you observe that, if you calculate and observe that your basic necessities are coming only to 30% or 35%, so that doesn't mean that you have a bandwidth to spend the other unnecessarily. No, it doesn't mean that. What it means is a lot of times, a lot of us have home loans and other loans and things like that. So EMIs and your basic necessities, insurances, everything put together should not cross 45 to 50% of your household income. So that's the ratio we all should follow. It should form within, it should come within 50% of the household income. The next 30% says that you can spend it for your wants. So that doesn't mean that if you're spending a little lesser, you should go ahead and spend it. Definitely not. So the maximum limit is your 30% of your household income you can spend on your lifestyle. So if you're able to, cut down on that and push more into savings, nothing better than that, right? So at least 20 to 30%, if it goes into savings and investments, it will help you achieve your dreams faster. You can create a better corpus for your retirement, and all your basic things are, basic goals, financial goals, and your aspirational goals will be taken care in a faster manner. So that's the budget and the discipline that every household today has to follow. So as we are growing in our profession and in our day-to-day lives, we are all becoming very aware of how to carry out our financial well-being, right? So there's a lot of content. There are a lot of financial advisors who are coming forward to a customer-focused approach, helping families decide what is best for them, their risk profile, and things like that. So slowly, things have to change. The 40% people today who have voted for a no, that they don't follow a budget, please make it a point that you write down. You write down your every monthly expenses. Initially, it might be a little. You might feel that it is a little bit tedious and you don't need it and things like that. But trust me, it will help you understand where you are spending unnecessarily, where you need to cut down, what more can you do to achieve your goals, how to invest, right? So because that also gives you a understanding of your risk appetite, how much maximum you're able to save, and whether that much is required for my goals. If your goals are taken care, then what else can I do to grow my wealth, right? So what is that risk appetite I can take? So it gives a better clarity. Following a budget and following it with discipline is very important. So once you know that you have a budget and you're started following it, the next question comes is, how many of you have an emergency fund? Do you have an emergency fund? Just ask this question to yourself. What is emergency fund? How much do I need as an emergency fund? What is it, first of all? An emergency fund is something which comes to your rescue when your other risk management tools are falling short. For example, let's say you have a medical insurance and something happens and there is a hospitalization or something, and there is a partial payment that is coming through the health medical insurance policy. The remaining you will have to shell out from yourself, right? So where is that money coming from? That comes from an emergency fund. So that is one example. Secondly, lot of us today are into private employment, right? Many of us are in IT sector and global MNCs and things like that. And we all know the situation that we are in currently. So there were a lot of layoffs some time back, and people suddenly lost their jobs, and they were in the verge of finding a jobs for themselves, where they were like without any income for a certain period of time. It could be like around 3 months or 6 months or things like that. What will happen to your EMIs? What will happen to your commitments? What will happen to your family if something like this comes advertently or suddenly, right? You need to have that emergency fund, correct? So, according to the survey that was conducted by Times of India in Feb last month, so they found that 75% of Indians do not have an emergency fund. And there is a likely chance that most of them can default on their EMIs if there is a sudden layoff, because they don't have emergency fund. They are also, highly liable to pay EMIs. They have loans. Okay, they are not protected through loan insurance and situations like that. So if something happens, they were likely to default. Now, what will happen if you don't have an emergency fund? Right? How is that related to my investing habits? How is that related to investing mistake? I'll come to that. So what happens is, most of the times when we fall short, we ask for a hand loan from our friends, family, right? Or we end up using our credit cards, correct? So that's all adding to the burden, adding to the financial stress. So it's very important to make an arrangement for an emergency fund. And how much of an emergency fund one should have? So earlier we used to say that about 4 months or 6 months of your expenses plus EMIs, you should calculate monthly EMIs plus your basic necessities, how much it is coming to, and you should multiply by 4 or 6 months, and that is what you should have as an emergency fund. Let's say your total commitments for the month are coming to 50,000 rupees, right? So for a 6 months period, it is 3 lakhs, right? So 3 lakhs is the emergency fund that this family should have, which has a monthly, fixed expenses and EMIs of 50,000. So like that. But now after COVID, things are changing. So there's a need for a little bit higher, emergency fund. So we always push our clients, whoever, we are talking to, and we are advising them on their financial planning and goals. We say that at least 8 to 10 months of your expenses should be kept in an emergency fund. So that's the minimum amount. So all of you, please calculate what that amount is coming to, and make conscious efforts to accumulate that money in a bucket, or in your savings bank itself, where it is there handy for you to access it in case there is a situation like that, right? So what are the consequences of not having an emergency fund? We discussed this, right? So we take hand loans from people we know, and we start using our credit cards, that those come as an immediate rescue, like emergency situations like that, right? But what it also does, it hampers your financial goals. Now let's say you have set aside some money for your child education, and that is, let's say, about 5 to 10 lakh rupees sitting there today, and suddenly there's an emergency situation, and where you don't have an emergency fund. Now if you go back and see what is the first bucket you will want to see, you want to come out of that, if there's no other source, the first thing that you will see is this corpus that is sitting there in a mutual fund, and you know that it is liquid, you can come out of it, right? Okay, so then you decide to go ahead and break that mutual fund corpus, which was supposed to be for your child's future, or something important. So you will decide to come out of it. Now, is this market situation really favorable to come out of these investments? No, it might not be. So what will happen is, you will end up coming out of this in a distress selling kind of a situation. So that is how your not having an emergency fund will impact your decisions of your investments, and your overall financial well-being. That is the first investing mistake that one should avoid, is not having an emergency fund. One should always have an emergency fund. So these are some basic things. The first basic thing is having a disciplined approach, having a budget, having making conscious efforts to save 25 to 30% of your household income for your future goals and for your emergencies. Next comes your consciously having emergency fund. so that not so that your goal buckets are not impacted, so that your investments are uh, they have set off on a journey, right? So you have made this decision to start this conscious effort to for your, it could be for your child's education, it could be for buying a house, which you said that okay, in the next 5 years I'm going to accumulate in this, and I'm not going to touch that fund till then. So then if there is an emergency, if you're breaking it, your goal horizon is broken and you're coming out of it unnecessarily, right? So to avoid all of this, to avoid any additional stress on your personal finance and well-being, it is always important to have your emergency fund. So the point is to make sure that you're protected. You're protected to take that risk. You're protected uh, at the back end, right? You have a back end support where you can stay invested no matter what. Correct? So that is how you should, handle things. These are the first two mistakes that we spoke about. The third investing mistake. Now, not buying insurance early. So insurance is one thing that we have observed that most of the people look at it like an unnecessary expense and adding to the cash flow of the family. It is not necessarily so, right? So insurance, of course, it's an expense, but it is protecting yourself and your family in a big way, right? Ask these questions to yourself, right? Is your life insurance adequate to protect your family's future? Do you have adequate health insurance? Now, most of you when I said insurance, most of you should have said, yeah, yeah, I have my life insurance. Yeah, yeah, I have my health insurance. But is it adequate is a question. Are you adequately covered with your life insurance? And what is that adequate cover when it comes to your life insurance? Yes, we have read in several books that, thumb rule of life insurance or term insurance is you should have 10 times your annual income as your life insurance sum assured, right? Let's say if annual income is 10 lakhs, so I should have at least 1 crore of my life insurance. So that's like a thumb rule. That is that is okay. But then when it comes to see everybody's needs, wants, and future goals, future plans are different, right? So somebody wants to send kids abroad, or the kid wants to go abroad to study and things like that. They have some bigger goals, some bigger commitments. You should consider all of that to arrive at look at what is the adequate life insurance that one should have for so that in case of his or her demise, the family members or dependents are not impacted with the basic financial goals or their basic well-being or their basic lifestyle, right? So if you are not aware how to calculate this, please take help of a good financial advisor who can help you arrive at a number or at a corpus where you can look at buying a life insurance. Now, not buying life insurance early is the biggest mistake one will commit. So the earlier you buy, you're locking that premium for the rest of the time or the term of the policy. Throughout the term of the policy, the premium remains the same in case of life insurance. So if you buy early, you will get a very reasonable small amount of premium every year. As you grow older, the risk that the life insurance company sees becomes more, and that is why they start charging you a little bit higher premium. So to avoid that, the sooner the better. The same applies to health insurance also. You have to buy a good health insurance when you're in good health, so that when you go for a medical examination, your policy is not rejected and your premiums are very reasonable. So when one is in good health condition, he or she has to go and buy a good health insurance, for themselves, whether it is individual, whether it is married with family. So if you have a family, you should always opt for a family floater. Within the family, if the eldest person has some ailments, then we have to segregate. The person with the ailment needs to have a separate health insurance, and the other three members can have one joint health insurance and things like that. Right? So these are some things or some basic points one has to take care of. Now, how is this related to my investing? You might ask. This is very much related because again, the same thing will happen. If you're not protected properly because of your life and because of your health, you will end up, coming out of your investments in a wrong time, or you're impacting your overall, well-being of yourself and your family by coming out of it. Because once you touch these funds, and once you come out like that, it will take a long time for you to recover from it. So the recovery takes time. Again, that impacts your financial goals, your investment horizon, the growth part, the CAGR, the returns, the XIRR, everything will be impacted because of you coming out of it in a long term, right? So according to this survey that Times of India had conducted, they saw that 82% of the insurance policy holders, though, are not protected, adequately. So they don't have adequate life insurance. So, and even they observed the same thing with the health insurance holders, that 20% of them did not have adequate health insurance. Yes, I have 5 lakh health insurance, I have 10 lakh health insurance, but whether that is adequate for the family, is it covering your critical illness? Are you covered? Are you traveling by two-wheeler? Are you covered adequately with your accidental death insurance, or disability insurance, permanent or partial disability? Anything can happen in today's life, right? So you should assess what are the risks that you have in life, and how any mistake can impact your overall investing and your overall financials, your family's financial goals, and things like that. One more point I would like to highlight here is your corporate health insurance and life insurance versus your independent. We see that a lot of us who are, a lot of the people who are in some good positions in good MNCs and good companies, they are protected very well with their corporate life insurance and health insurance. Yes, that is absolutely fantastic, and they're covered superbly, I would say, because corporate health insurance gives a lot of flexibility, or the terms and conditions are much more better. I agree to that, but you should also have an independent health insurance, if not life insurance. Yes, life insurance you should also have, but at least health insurance one should have independent. Okay, so at least if not a very comprehensive one, a basic one you should have. So what that will do is, first thing, you're ensuring you're taking it in a right time when you're in a good health condition. Secondly, you're ensuring continuity. Even if you're not using that policy, there is this no claim bonus and other things, other options that are getting added to your policy. So there's continuity, there's accumulation, and it could grow to a number by paying the same premium. Thirdly, it will help you to avail, if in case you choose to switch jobs, right? When you're in between jobs, and when let's say in this situation, when you're in between jobs, when you're in your notice period, when the new company's insurance is not yet started, and situations like that. So it will help you protect in those times. And fourth, definitely when there is a layoff, you definitely know the importance of having this health insurance. So these are the important points one should consider to avoid, doing, or to reassess. So take this webinar as a point where you reassess your life insurance and reassess your health insurance needs, and do what is required. Now, as we are meeting clients, people come to us for advice and things like that. One thing we have observed, that there is very little or very no awareness about this top-up health insurance. Okay, I'd like to play a video here so that you are aware of what is this, and it might help you in your help you to buy.
Worried because your existing health insurance cover is less? Here is a solution. Buy Super Top-Up policy, which is a cheaper way to upgrade your health insurance cover. Say you have an existing cover of rupees 3 lakhs and you want to increase it to rupees 10 lakhs. Buy Super Top-Up policy of 7 lakh rupees with a deductible of rupees 3 lakhs. The deductible is the amount of hospital bill which you need to pay from your base policy before the Super Top-Up policy is to be used. Now, if your claimable hospital bill is 4 lakh rupees, then your existing policy will pay 3 lakh rupees, and the remaining 1 lakh rupees will be paid by Super Top-Up policy. If you fall ill again and run up a bill up to 6 lakh rupees again, don't worry, your Super Top-Up policy will take care of it. Super Top-Up policy is available for individuals also, and as a family floater also. Call us now to buy.
So this is how the Super Top-Up policy works. So there's something called as a deductible limit and that will be your basic policy that you're paying premium for, whether it is 3 lakhs or 5 lakhs. And you can opt to go for a super top up policy, let's say for next 30 40 lakhs or something like that, but the premiums for a super top up are very low. So one can have this as a additional cover for the family. So this is a small graph which shows the how the mortality rates in India are changing over a period of time. Earlier, it used to be very high, and slowly you can see that there's a minor increase and things like that. But then mortality rate will always be there on an average, right? So the life expectancy is increasing. The life expectancy is increasing because of good medical facilities, and people choosing an active lifestyle and things like that. So it is always good to protect oneself from the longevity perspective. So the next mistake that one should avoid is a proper loan management. If you don't have a proper loan management, that also impacts your overall financial well-being and your investing capabilities also. So as per this survey, more than 17% of Indians have loan more than what they can really service. So the debt servicing ratio is quite high for at least 17-18% of the people in India. So when the surveyors asked these people, like, what do you do if you run out of money and if you're not able to pay your EMIs, 57% of them said that they are going to sell off their investments. See, this is exactly what we are trying to discuss here in today's webinar. So the first option that comes in case you have a lot of loans and you have trapped yourself in a debt trap, right? It's very difficult to come out of it. So it makes sense to always assess what is your debt servicing ratio, or how much it is that you should ideally take as a debt. What is that ratio of debt that is okay for me, right? So that assessment is very important. Now, if you don't have an emergency fund, if you don't have proper health insurance, life insurance, and things like that, situations will arise in such a way that you end up selling your investments, number one. Number two, you'll end up using your credit cards, taking hand loans, which is again adding to that is again the amount of people that the amount of money that you owe back to people becomes more and more, in case you don't have all these tools and techniques to protect your risks. That is a simple bottom line of this discussion today. The other people said that they are going to take another loan to pay off this loan. That's a very bad idea, right? Skipping your EMIs, that is also a very bad idea. See, whenever you're taking a loan, you should always be aware of what is a good loan and what is a bad loan, good debt and a bad debt. So what are these good debts? Are something which is adding value to you and your family, which is adding like an asset which is growing. Let's say an independent house, or your first house where you want to live. That is a good asset, and there's no compromise on that. Education loan. So these are some good loans which are adding value to you. Car, of course, one has to, a family, if there is a family of 3 or 4 people, small children, old people, parents, and things like that. Today's generation, everybody needs a car, right? So you go for a car loan. But then unnecessarily, buying, 2 or 3 cars just out of, interest or fascination or things like that. So those things should be avoided, because car at the end is a depreciating asset, and the interest rates on that are very high. So you will somehow that will affect your overall cash flows and savings capabilities and investing capabilities. The other way to see is there are a lot of we get a lot of calls these days that you are eligible for a personal loan, easy cash, easy money. Some apps are offering easy loans and things like that. Please don't go for all of these. It's like a scam. I don't know what exactly, but people are falling for it, right? They might. So the idea is, why people go for these things is because they're not prepared for the worst scenarios in their finances, right? So these are the things one should avoid, and have a focused and disciplined approach. The next thing is not following asset allocation. So what is asset allocation? It is nothing but having a proper mix of equity and debt. It used to be earlier, right? So as debt asset allocation is again relevant to your age and your risk profile, right? How much I can have in equity related investments, market related investments, and how much I can have in fixed income or fixed return investments, safer assets. So those are the things. So now there was one more video here. I am sure again I'm facing the same.
Abhimanyu, son of great archer Arjuna, was a great warrior when Kauravas created a Chakravyuh during the war of Kurukshetra. Abhimanyu knew how to enter the Chakravyuh, but didn't know how to exit from the same. This ignorance of exit strategy costed him his precious life. Similarly, most investors are also like Abhimanyu. They invest in equity but don't know how and when to exit. We all try to enter at low and exit at high. Easier said than done. What is the solution? Follow asset allocation strategy. Asset allocation means deciding the ideal mix of equity and debt proportion in your portfolio and review it periodically. Asset allocation will automate the process of buying more when markets are low and booking partial profits when markets are high. To maintain the asset allocation, when equity exposure goes up due to surge in markets, sell some portion of equity and invest in debt. When equity exposure goes down due to correction in market, sell some portion of debt and invest in equity. Or you can just invest in hybrid mutual funds with fixed asset allocation mix, which does exactly the same. To find out the ideal asset allocation based on your risk profile and to review it periodically, take the help of financial.
Yeah, so that's about having a good mix of asset allocation. So nowadays, having a multi-asset allocation strategy is very important. I had conducted a webinar some time back regarding how you can hedge your portfolio, how you can use hedging as a tool to protect your financial goals and things like that. So there I had covered avenues like gold, real estate, and other investments that one can look at from a hedging perspective. So why this multi-asset allocation strategy is important is one is because every see the equity markets or any market goes through a cycle. So it goes up and it goes down and things like that. So when one asset class performs, or when one asset class is doing good, the other asset class is not performing well. So so it's vice versa. For example, when the equity markets are good, generally you will see that, or when the equity markets are at their all-time high, you will generally see that the debt market or the gold market are not performing that much. That is because a lot of investors choose to move money from the debt or gold and move it into the equity markets. And the same happens vice versa. When the equity markets are very volatile, people don't know what to do. They start, diversifying or, taking other routes like, real estate, commodities, gold, and things like that. So you should know what is that proper mix which is suitable for you, for your financial goals as per your risk profile. So diversification is at the top of all of these things. We all know the saying that don't put all your eggs in one basket, but over diversification is also harmful. So within the equities also you have your large caps, mid caps, small caps. So there also the diversification plays an important role. So over diversification, like having 15-20 mutual funds, 15-20 stocks or things like that, which are scattered in a very unscientific way across all the sectors. So you should have your portfolios reviewed from time to time, whether this allocation is good for me, whether this fund is helping me. The main idea is to clean up your portfolios. Clean up in the sense, what happens when there is over diversification, too many funds, there's overlapping. There's definitely overlapping, and your returns get diluted. You will not see good returns in your overall portfolio. So you should have a good focused approach, a good concentration, a good mix of your multi-assets put together, which are helping you achieve your inflation beating returns, which are, inflation is different. See, your general inflation is around 7%, and education inflation is about 10 to 15% range, right? Medical inflation is also in the range of 10 to 15%. So when you start your investing journey and when you have decided for which goal I'm using this part of my savings, when you have set off on that journey, it makes sense to have an approach where have a mix which is helping you achieve these goals. And very importantly, when the goal approaches, and if you are over allocated in one specific market and when that market is not doing good, and you don't have enough resources in other asset classes where you can pull out, then that also hampers your overall goal achievability. So if you have not attended my previous session on this, hedging as a tool, as an important tool, you can go to our YouTube channel and you'll find that video there. I've discussed all of these concepts in that video. So again, yeah, like I was saying, right? So it depends on the risk tolerance, what kind of asset mix one should have. So these are typically the risk profiles that we normally do as advisors. We have a risk profile questionnaire, and that's how we gauge what is the risk appetite of the client. Whether it is moderate, that is whether the client wants to take a balanced approach, moderately aggressive to aggressive. This is on the riskier side. On the right hand side is the conservative side, or they don't want to take in a risk, or they are in a situation where they cannot take a risk. So all your financial family situations, your personal situations, and your age, your financial goals, everything is considered to assess the risk tolerance level. And then the age also plays an important role. At what age of your life cycle you are in, which can affect your investing decisions. So the younger you are, you can take more risk and more into equities. As you grow older and reach your retirement age, your equity proportion should be balanced or cut down, and more should be towards debt and fixed income kind of resources, so that there's more liquidity for you and you're not putting your hard-earned money to risk, right? So that's how the asset allocation needs to be designed. Now, if you don't have the bandwidth to design this a portfolio for yourself, to look at what asset classes I should consider, there are a lot of multi-asset mutual funds also available today in the market. So you can do some research on that and put it there. So there it is a headache of the fund manager to do it for you, right? So he or she will choose which is the asset class. They should be diversifying the assets, and this is an example. It is just an example of how a multi-asset fund portfolio will look. Like it could be like 44-50% in equities, 28, 29, 30% in debt, some in commodities, some in real estate. Sometimes there is a gold proportion also in some funds. So it will be designed in this way, and they keep playing around based on the market cycles and situations. They keep playing around and rebalancing the portfolio, so you don't have to worry about it. So you can go and choose this as your portfolio. Next, so everything starts with discipline, and you should have a good financial plan. Good financial plan will take care of your protection needs, your risk, and it will help you arrive at your smart goals. What are your smart goals, and how you should start looking at things, and how your cash flows look from now until your retirement or post retirement. How you should plan for your longevity. What if I live after 80 years also? So do I have the corpus not to depend on anybody in my family? So all that will be taken care with a financial plan. Now a little next step. So what is, if you all are wondering, like in 2023 we are seeing that the markets are very volatile, right? So people are confused basically. We as wealth advisors, we are also like take help and support of a lot of research activities, like what can be the situation. So we did a lot of research and we saw that the theme for 2023 is value based investing. So if you're looking to deploy some funds, you can look and deploy it in some value stocks or some value investments, value based mutual funds, value oriented mutual funds, and things like that. So what these investments refer to is some stocks or some investment opportunities are identified which are trading below their intrinsic value, which means that their they are underpriced. As simple as that. Actually, the value of that corporation or value of that enterprise is very big. The value of the business is going to be very big, but at present, people don't recognize or people don't identify. The markets are not identifying them, and hence those stocks are available at a very reasonable or a very cheap price. And this is where we are looking a value in that business, and we are entering it. We are buying it, and after 4 or 5 years, we are we expect that there is recognition for this business. This business will find its value. There will be growth spurt, and these are going to go forward and explode. And that is when we are going to exit and make some money out of it. So that is called value investing, right? So that is the theme for 2023, because as per experts, the markets are going to be a little volatile over the next 1 or 2 quarters. And that is when, we should look at accumulating or deploying money and accumulating some good quality investment opportunities. So here we have, Right Horizons also has, come up with this investment opportunity in the small cap space, which is called super value aggressive. So there also we are identifying a few multi-baggers where the opportunity is very fantastic or very attractive to enter at very reasonable and throwaway prices. Now, some stocks they have identified, the research team, and they're going to enter now in the first 2 quarters, this quarter and next quarter. And the expectation is that over a period of 4 and 5 years, there is going to be 5x 6 times type of growth. And so this is a fund that our research team has come up with. So that's something new that we as an organization have come up. And so we just wanted to discuss the importance of value-based investing at this market situation or the kind of markets we are in. So you can explore some opportunities on that. So we have discussed a lot of basic things which can of your personal finance, which can impact your investments, long-term investments. Your 360 degrees for yourself and your family with respect to your emergency fund, with respect to your life insurance, health insurance, and your loan insurance, right? So that is the foundation of all of this. Then comes your savings part. You should be able to save at least 25, 30, 35% of your savings to take care of your financial goals, and then also let you with some corpus where you can play around with and explore some opportunities which can give you exponential growth. Wherever there is exponential growth, of course there will be the risk. So saving appropriately will also give you the bandwidth to explore these spaces where you want to look at investing. Then comes the growth part. You should let your portfolio grow, stay invested for a long term, be there in the market to enjoy those growth periods, and then take some more risk. After you have achieved a stage, you will know that you are able to take some more risks, and then you enter that space. Like it could be alternative investing, startup investing, for example, or something like that. And then comes your wealth creation and your next level of investments, wealth management parameters. So that's for today's session. Just a few key takeaways for today. Discipline is the key. You should always learn to follow a budget. If you don't have a budget, please prepare a budget now and start following it. Protect all your risks, right? Investing without having proper goals, without having a destiny, it's just like shooting in the dark. Don't be very very return focused. Returns are like it should be treated like a byproduct. Do what is right for your investment, do what is right for your money, do what is right as per the current economic and market situation, and that will take care of your future needs, your future investment plans. And asset allocation is very important. Design your portfolio in a very focused and scientific approach, and look what mix works best for you. So that's it for today. And if you need any second investment, second opinion on your existing investments, or if you want to plan for your future goals, you can always get in touch with me. And that's my contact details, my email ID and number you can use. Now we can take some questions. Yes. So, yeah, I'll just take 2 minutes to just go through the questions so that I can take the best ones. I see that there are a lot of questions in the chat box. I'll try to answer most of them. Okay. So, the first question I'll pick up from Prashant Shivarkar. So, you're asking, can you cover the best options for short-term savings instead of maintaining the same? I think you missed or something. Which is the best option to park the emergency funds? Okay, see, now what has happened is debt mutual funds taxation has changed, right, recently. So it is as good as, FD taxation. So earlier we used to say that have it 50-50, like 50% in your savings account or a flexi FD kind of a thing, and 50% in your short-term debt, ultra short-term debt or a liquid mutual fund, or things like that. So we still are okay with that because see in FD what happens, you don't have if you choose not flexi FD, let's say you choose a FD of 1 year, 2 year, or 3 year, then you don't have the flexibility to come out. On the other way, debt mutual funds, yes, the taxation is the same, but you have better flexibility. So you can choose. But if you ask me from a very practical purpose, having it in your savings account is the best. That is because you can use it through your Google Pay. You can use the money through your Google Pay or your credit, your debit cards. You can use the ATM, and any time it is accessible. If you put it in other avenues, it might take 2 or 3 working days for the same to to liquidate and come back to your account. So savings account or a flexi FD is a better option when it comes to practical use of emergency fund. So Ashok Shah is asking, emergency fund is if you stop earning or for situation like medical emergency or other emergency, where to keep that fund? Exactly. So it is best to keep that fund. See, everything cannot be looked at from a growth or from a return perspective. This fund might not give you any return. Okay, it might give you just 3%, 2% return. You should be okay with that because this is more for you for your emergency needs and not for return. So it doesn't matter where you're keeping it. The idea is to have access to these funds when there is a emergency situation. Okay. Also, as a part of emergency thing, I would like to highlight that it is always a good idea to share, some details with the close ones that you know. For example, husband and wife. So as simple as where to look for things, what insurance policy you have, who is the contact person, people should know. If they are not aware, you should make them aware. It is all about accessibility. See, in an emergency situation, it is all about accessibility. How fast and how quickly people around you can have access to help you out of that, or you yourself can help you out of it in case of an emergency. So decide it that way. So best is to keep some part in savings account. Usually, what happens in savings account, we end up spending it. So another facility a lot of banks are offering is the flexi FD, where it is parked for the time being and it is earning, I think, 1.5% better returns than your savings account, but it is parked as an FD, which is segregated. But in case you need it, you can also always break it through your ATM itself. So it's like that. So you can discuss with your bank and look at options like that. If you want, you can reach out to us as well, and we can look for options for you. So there's one question, interesting question from Alpesh Savla. So he is asking if there is zero emergency fund and also no savings instrument. Instead of saving all for emergency, can we start saving for investment as well as emergency fund together? Absolutely, you can do that. So what you can do is most of it you can put it in an emergency fund and some portion in your for the long-term investments. You can choose whether you want to do it like a 50-50 or 60-40 kind of an approach with the monthly savings that you have in hand. You can do that. But it also depends on what situation you are in, right? So if you feel that there is a threat to your income or some situation like that, then you should first concentrate on building an emergency fund or having these policies or tools which can help you out of it, right? Prashant is also asking, do you recommend to have term insurance at the verge of retirement or when you don't have any liabilities? No. See, the idea of having a term insurance is income protection basically. So let's say you are the main breadwinner for the family, the earner of the family who is taking care of everything, all the expenses, EMIs, and everything. So in case something happens to you during your earning years, there's no backup for the family. So this income completely stops if something happens to you. So in this case, we recommend having a term insurance. As you're on the verge of retirement, when you see that your kids are grown up and they are independent and they're on their own, they're not depending on you for anything. So your only liability or your only thing comes is your wife. So if you have built a good corpus for yourself and your wife, there's no need of term insurance. But some people also look at term insurance as a legacy planning. So they still want to continue the term insurance after retirement, so that when they are no more, a corpus comes to them or the nominee as a passing on of the thing, property or wealth. So like that. So most people do that also. But as a need, if you're asking me whether there is a need or whether we recommend, we don't recommend. If your goals are met and if your retirement corpus is taken care, if uh, uh, your cash flows are taken care post retirement, we don't recommend, because at that time your premiums will be very high, and that will add to your cash flows, because after retirement usually the income is less or you choose not to work at all, right? So you're withdrawing from your corpus. At that point of time, we ask our clients not to have a commitment after post retirement. So that's how it is. Yeah, Ashok is asking, what should be the amount of term insurance? So, like I said, if you have attended the initial part, I was mentioning that earlier, the thumb rule says that 10 times of your annual income should be your sum assured of your term insurance. But it is important to calculate all the things, like, for example, how much you need for your child's education, how much your wife will need in case something happens to you, and things like that. So, arrive at that calculation and deduct whatever current policies you have and what is the remaining balance cover that you should be having. Otherwise, if you want to just follow a thumb rule, let's say 10 to 15 times of your annual income, you can have a term insurance. Yeah, there's very important question. What is the difference between top up and super top up? Okay, so there are few differences. I will just quickly explain one or two. So in a top up, what happens? You will not be allowed to claim multiple times in the year. For example, there's this deductible. Only after the deductible you will be allowed to claim from the top up. But in the case of super top up, it is not so. You can there are multiple options available. There's a long list of these differences. Maybe I can share that on an email. Okay, so there are quite some good options. So it is always super top up is the best option. It has a lot of flexibility. Okay, multi-asset mutual fund is good enough for diverse portfolio, or it has to be individualized allotment like property, gold, etc. Ashok, I'll answer that maybe on a one-to-one chat. Maybe I can call you and answer that for you. For emergency fund, what are the best options? I've already discussed that. Value investing and value mutual funds are similar. No, value investing can be mutual funds also, can be stocks also. Value mutual funds are some mutual funds where the fund manager is doing all the research. He is investing into value stocks and passing on the returns to you, where you are not breaking your head looking which stock to purchase, what is its value, how to calculate this ratio, that ratio. All that homework is being done by a mutual fund manager on your behalf, and he or she is investing on in those stocks. In value investing in stocks, individually we have to do a lot of research, understand the ratios, understand the business potential, whether it has a growth potential in the future or not. So that is something value investing. So is it a good option to invest in equity or hybrid fund? Okay, so both are good. So I would say both are good. So there's, like I was saying, right, you should follow a asset allocation. Like within equity also, what are the different types you want to look for, right? And what is your target uh, horizon? What is your target return that you're expecting? And for what purpose this investment is.